To moderate this panel, I am delighted to introduce the incredible Chisara Ehiemere, who is the Senior Research Lead for ROSI at CSB. Chisara has over 20 years of experience helping companies understand the sustainability impacts of their sourcing strategies and guiding them in building socially, economically, and environmentally sustainable supply chains. In her roles at Field to Market and Fairtrade USA, she brings deep expertise in assurance, certification, and long-term growth strategies. It's my pleasure to welcome Chisara and her panel.
Thank you so much. All right, thank you so much for the introduction. Again, my name is Chisara Ehiemere, Senior Research Lead for Return on Sustainability Investment. And as you will have seen throughout the day, it's really exciting to be able to take ROSI and apply it to such a variety of industries. And so today, for this panel, we're going to be talking about a collaboration that CSB has with the Multifamily Impact Council. And the Multifamily Impact Council, unfortunately, Bob was not able to join us today, but it is an organization, a member organization that is focused on creating common standards and transparent reporting guidelines to drive more impact in the rental housing industry. And they have 7 principles that they have within their framework that we are using as the definition of sustainability within the multifamily industry. And so the 7 principles that they have, and what we are testing through our work applying ROSI to this framework is that there are affordability, we have resident engagement, economic health and mobility for residents, housing stability for residents, health and wellness of the residents that are within the multifamily housing, climate and resiliency for the building, and then also the impact of that on the residents within the building, and then also the principle of good business. And so what we have been exploring and are continuing to explore is what are the business implications of adhering to these principles when constructing and renovating and making changes to affordable housing. One stat that I will have is that the U.S. has a shortage of 7.1 million rental homes that are affordable and available to renters with extremely low incomes. And then what that means for many families is that not having that access to that housing means that they also don't have access to related services for them. So we will go ahead and start our panel. We have to my left, Fabiola Edouard, who's the Vice President of Asset Management with the Vistria Group. We then have Chris Herrmann, who is Executive VP and Chief Investment Officer and Fund Manager with Enterprise Community Investment. And then we have Lauren Zullo, who is the Managing Director of Jonathan Rose Companies. And what I'd like to do just to get started, I know we have a varied audience today, some with real estate experience and others with not, is for each of you to give a little bit about what you do within your company, and then also a strategy that you have used to make the business case for affordability. There are a variety of strategies, and let's actually start with you, Chris. If you can give an example using tax credits to help our audience understand what affordability can mean in this area.
Sure, great. Happy to be here. Thanks for having me. So I'm Chris Herrmann. I work for an organization called Enterprise Community Partners. Enterprise is a 42-year-old nonprofit organization that focuses on affordable rental housing in the United States. We carry out our work through 3 different categories of work. We develop, own, and operate our own properties. So we own and operate about 125 rental housing communities serving 22,000 residents in the Mid-Atlantic region. We're headquartered in Columbia, Maryland, so that's a very local business. We are an investment company, and that's the part of the organization I represent, where we aggregate and invest debt and equity capital in support of the creation and preservation of affordable housing. And then lastly, we're a program and policy expert. So we work programmatically across the United States to advance different initiatives, and then we advocate for public policy at the federal, state, and local levels that is aligned with our mission. And so I represent a group that raises real estate private equity funds, and I think all three of us here do the same. And we specifically focus on acquiring older vintage affordable housing properties that were built between 15 and 30 years ago and are aging out of their affordability restrictions. So our intent is to generate a financial return by investing in these assets, but also to achieve demonstrable and measurable impact. And so every investment we select for one of our funds, it has to meet both of those goals. We're a member of the Multifamily Impact Council and largely follow the 7-item framework that was just shared. And to share an example, we recently invested in a property that is aging out of its affordable housing restrictions, meaning within the next year, that property has an opportunity to be converted to market rate housing. And so those are the kinds of properties we target for investment, where we can build a strategy that commits to permanent and long-term affordability while also generating economic return. So you might wonder, how do you do those two things at once? And that's really kind of the role we serve in the industry, is to sort of facilitate that. And I like to think of it as we're assembling a puzzle of resources that allows us not only to replace the foregone returns of converting that property to market rate housing, which there are, right? Raising rents $250 generates value. How do we replace that foregone value, and how do we create more? And so in that example, we assembled a puzzle of resources in partnership with the county and the state that included a county grant for a couple $1 million, a property tax abatement that we were able to secure locally that reduced our operating expenses and generated an increase in net operating income. We're executing a climate-focused strategy to conserve natural resources and, of course, lower our utility costs in the process. And all of those things combined, we charted them out and found that those things generated about $8 million in property value in comparison to roughly 6.5 of foregone market rate conversion opportunities. So we very much think of these kinds of strategies as impact that drives value and not impact that necessarily sacrifices value creation.
Great, thank you. Fabiola, I'll then ask you a question about converting market rate properties to affordable housing and the business case for doing that.
Hi, everyone. My name's Fabiola Edouard. I'm a VP in asset management at the Vistria Group. We are a real estate strategy, core plus perpetual fund, and our goal in the market is to seek to preserve, improve, and produce affordable housing in some of the high-cost markets across the United States. An example of a market rate to affordable conversion that I'm super proud of is the one that we recently completed in San Mateo, California, which is one of the wealthiest counties in the United States. And the tax exemption strategy is basically whereby we, as property owner, will receive a tax deduction, sometimes full tax, real estate tax exemption, in exchange for preserving rents at 80% or below area median income. In California, the strategy is called welfare tax exemption, and that's one of the strategies that I'm super proud of that we were able to do.
Great, thank you. So with the gap in need for affordable housing, I know that there's another strategy, which is ground up development. I understand that there may be challenges with those, but that they are also a strategy that can be successful. So Lauren, would you tell us a bit about how those strategies work?
Yes, happy to. I'm Lauren Zullo with Jonathan Rose Companies. I'm the managing director of Impact. We have I'm really happy to go after these two because we have a similar strategy to the low-income housing tax credit redevelopments, and we invest out of a private equity fund as well in the creation and preservation of affordable housing. But so many people think about how do we build it new, right? And so we do that as well in major markets across the U.S. from coast to coast. And I'm happy to talk about a specific project because I think it beautifully weaves together actually some of these strategies collectively. So We in 2017 purchased one of Rose's private equity funds purchased an existing Section 8 affordable housing property in Washington, D.C. It had 80 units across this garden-style complex. We had two business plans when we acquired the property. We thought, hey, maybe we can do our typical playbook and do some value add, bring impactful services, and then sell it to a preservation buyer. We had a second business plan in mind that considered whether we could bridge this investment to a new development, to a redevelopment of the whole site. The existing housing was from 1979. It's tricky to preserve, and we knew this was a location on the 14th Street corridor in Washington, D.C. that could use additional housing. So through zoning and through a partnership with a market rate developer, we were able to quadruple the number of apartment units at the site. And we split the lot into two, and we now have a side-by-side affordable housing property next to a market rate property. And on the affordable side, that's the development that we led. It increased the number of affordable units from 80 to 125. Of those new units, I'm really proud that 23 of them are three bedroom units, which can help house families. And I think that's a big gap often in affordable housing. Frankly, in market housing too, as I'm trying to release in New York City. And so this is where I'm going to take a look at my comfort notes down here, because the way I like how Chris described it as a puzzle, right? I think I often describe it as a Jenga tower, right? Assembling a capital stack for an affordable housing project. Our core financing products were from public and private sources. We utilized low-income housing tax credit equity from a private investor, tax-exempt bonds, a HUD loan that was through Capital One, a loan from the Housing and Community Development Corporation in DC. We have some annual rent subsidy from the district on top of the existing subsidy that we have from HUD, right? So this complex capital stack, every piece of that was dependent on our affordability strategies. We have a portion of the property that's subsidized through Section 8 and is available to renters earning less than 80% of the area median income. We added another layer of units restricted to households earning less than 50% of area median income. We have a section of the property that's affordable to, that's what's called permanent supportive housing, which is housing families that are coming, typically transitioning out of homelessness, right? And so each of these affordability strategies unlocked a different level or different layer of financing for us. And so as we assembled this Jenga tower, we were not only looking at our affordability strategies, but also thinking about how environmental and social strategies could play in as well. And so I'm super proud on the environmental side of this particular property. It is LEED Platinum. It's passive house, which means it's incredibly well insulated, and it reduces our utility costs by about 50% compared to a traditional building. It also has a really cool feature like a solar integrated green roof. By doing this, we were not only securing investment tax credits for our solar, we got a boost on our tax credits because we're an affordable housing property. And a portion of those utility savings are going to subsidize Wi-Fi inside the building. And then also, I guess I'll just add through these strategies as well, we knew we were going to be pushing the sustainability envelope. That was one of the goals for this project. It's fossil fuel free, has EV charging. It's a really cool project. And in order to push that envelope, we worked with the DC Green Bank to create a bespoke loan product that allowed us in the pre-development stage to bring in all of those consultants and experts and technical folks to help us make this project a reality. And so it was really, I think as Chris said, it was really through our impact strategies that we were able to A, put the deal together to begin with, but B, kind of just really enable it to drive returns, to bring in developer fee, and to add value to that location in DC.
Great, thank you. All of the projects sound really impactful, and I'll ask a little bit more about some of those later. I do want to ask, because I don't want us to end on a bad note, so I'm going to ask a question that I'm sure is on the minds of those who are listening. I'll ask it now. I was at a real estate conference a couple of weeks ago, and the panel on affordable housing really did not have a level of certainty. There was a feeling that many of the projects had to be put on hold as decisions in this political climate are being considered. And so I'm just curious as to whether you agree with that perspective. And then also, could there be a continued business case without federal funding? Again, getting that out of the way, and then we'll talk about the other principles.
I guess I could take that one first. I think everyone's uncertain with what the path forward is as in terms of subsidies for affordable housing and sustainability projects, et cetera. I tend to be like more of an optimistic person, and I don't think that any decisions that are made through our policymakers are going to be detrimental or hazardous to housing across the board. Our portfolio has less exposure from subsidies. And so we think about it. We're staying on top of the pulse. We have conversations with policymakers across all the cities that we're invested in. And some agencies are taking a pause. Other agencies are still kind of supporting us with subsidy. And so I think we just kind of need to have it play out.
Yeah, I would agree. I would say, we talked a little bit about the puzzles and the Jenga towers. And of course, a puzzle is not complete if it's missing some parts, and Jenga towers fall down, of course. So that's what we're talking about, the risk of these sort of pieces shaking out and sort of being absent. I have, a lot of optimism because housing is a bipartisan issue. People are struggling to afford to become homeowners or to pay their rent in red districts and blue districts and really everywhere in this country. It's no longer just an issue in major metropolitan areas. It's really a crisis everywhere. And so, my sort of word of the year is perseverance. Just, don't overreact, be really thoughtful, but at the same time, try not to jump to conclusions. We just have to see how it all plays out. I do think, though, that there is an interim chilling that we're observing, even in the investment community, right? We had all our annual meetings for our funds last week, and got a lot of questions about rental subsidy and capital subsidies. And so that is going to have a short-term chilling, I think, on sort of fundraising, and sort of there will be deals that slow down and get stalled. But, this has been an industry and an issue for a very long time, and there have been bumps in the road politically, economically. And I have a lot of confidence that as long as there's an issue that needs solving, right, there will be resources. They might look different and be different in how they're structured, but there will need to be resources because this kind of housing can't be developed absent subsidy, right? That we know to be the case.
Yeah, I agree with everything that's been said. Certainly, there's a lot of chaos and uncertainty that's happening. We have specific programs that we were looking to benefit from, include through grants and loans intended to enhance resilience of assets that HUD has long-term contracts with that are frozen right now. And so certainly, I think that uncertainty is leading to a slowdown. Functionally for us who have a lot of subsidized properties too, there's things like closures of HUD offices that will make what are somewhat long processes to begin with even longer, right? And so I think things will slow down for a while. But look, I think the U.S. is one of the most innovative markets in the world. I think we have philanthropy and innovative private capital that are trying to come in and solve some of these solutions or solve some of these problems with innovative solutions. And, I think as long as we can get back to a place of some certainty, then business and investment will innovate and will find a way, to work through these solutions. But it is, it's a chaotic time, but I think we'll come out stronger on the other side.
Great, thank you. So let's move on to some of the other principles within the framework. And we have started the analysis of some resident data, really to try to understand how the provision of services to residents can help and have net operating income impact. And some of the examples that we've looked at have been things like the provision of after-school care for children, looking at food giveaways, looking at services that connect residents with existing services that they may qualify for that they may not be aware of. And so I'm interested in understanding examples that you may have that support the theory that the provision of services can positively impact NOI. And maybe start with Lauren and then come to you, Fabiola.
The math is pretty simple. Stable residents increase property values. And that's because households that are stable will pay their rent on time. They can endure through market cycles. They don't get evicted, right? And all of those factors improve a property's net operating income, which is the main kind of factor in valuing a building, by reducing our turnover costs, reducing vacancy, reducing legal expense. And so the question then becomes, how do I increase my residents' stability? Well, these are whole people with whole lives and whole families and a whole variety of complicating factors that may lead to instability. So the way we approach resident services is thinking about what are some of these main drivers. And we go to our residents and we speak to them about what are the disruptions in your lives. And, and so those may be things like, health issues, right? That could lead, that's one of the number one causes of bankruptcy in the US is around medical expenses. Well, then we ask, how do we improve our residents' health? So we're bringing, vaccination clinics to site. We are bringing doctors and medical services to the site and access to low-cost, fresh, healthy foods to site. The disruption could be due to job loss, let's say, or some other financial factor. Well, we bring financial security education. We help residents build credit through a credit reporting program. We provide microloans or help them access tenant rental relief funds. Or it could just be turnover leading to unhappiness or disconnection from your neighbors, and so they want to leave the site. Well, we even try to improve that through community building, cultural programming. And so all of these, impact aside, right, all of these factors enhance our resident stability, which in turn enhances our property values. So the ways we're kind of looking at this and measuring this are in a few ways, right? We're looking at our property performance and calculating, vacancy and turnover and the costs associated with that. We're also tracking our programming so that we can start to see what's effective, what's not. And increasingly, we're trying, this is a challenging project, I'm sure, for the multifamily owners in the room, but we're trying to get more and more resident surveying, right? So we can understand from our residents themselves how they're feeling about their stability, health stability, financial stability, et cetera, so that we can, instead of just getting to these kind of property level outcomes, start to see those leading indicators. Where do we have the health problems? Where do we have the financial insecurity problems, so that we can start to address those? We're doing that right now, on an individual level and through positions we call resident service coordinators. So we do build relationships and try to understand our residents. And we're trying to do that in an even more data-driven way through comprehensive surveying.
Great.
I would add, we're doing pretty much the same things that you guys are doing too. And I think I would just add on the survey piece. And so we developed a survey that anytime we acquire an asset, we deploy across each property. And that survey basically asks questions around kind of like, what programs are important to you? Where do you think there are any gaps? How can we improve your living conditions? And so we take the data from those surveys to kind of develop more tailored resident programming across our portfolio. We invest across the gamut of affordable housing. And so we have some assets that are fully affordable, but most of our assets are mixed income. And so we do want to and do layer in social services across the portfolio. And so and that design is based off of the demographic. So we might combine maybe having a resident services coordinator there on site for half the time, or complementing it with online kind of financial literacy, food education, and all those things it's hard to correlate resident and social impact to NOI results. It's easier to do with like sustainability and those improvements. But you do notice, like if you were to plot kind of which assets do have social impact or social programmings versus the ones that don't, you tend to see higher retention, less vacancy, and less eviction costs as well.
Thank you. We'll move on to another one of the principles of the framework, which is around climate. And Lauren, earlier you mentioned Ground Up, where you were able to design a passive house and get LEED certification. And we know that is not possible in most cases. So Chris, would you like to share with us some of the experience you've had with retrofits and using retrofits as a way to develop climate smart buildings and the business case for that?
Sure. Yeah. And I'll acknowledge it's been a bit of a journey. Our very first investment we made through Fund One was a 120-unit senior building. It was a HUD property, Department of Housing and Urban Development. And we did an energy audit, and this was 15 years ago. We focused on LED lighting retrofit, water conservation measures. We upgraded the HVAC systems, sort of the obvious things, and measured the return on investment of those things, the saved water and electrical consumption and gas and so on and so forth. Those were sort of early days of sustainability, right? And it has evolved over time. Today, every investment we make has to sign up for utility monitoring and benchmarking. So we're understanding our use in real time. What we found is, you can think you do it once 15 years ago and you're done. The technology is constantly changing and you have to stay up with it. So it's evolved into more of an ongoing investment in sustainability. And obviously more recently, we have the sort of movement towards decarbonization and electrification. And so right now in our portfolio, we own a 522 apartment unit property that is gas, HVAC systems, and just not terribly efficient. And it's built in the 70s, all those things. And so we're going through within our own portfolio. This wasn't part of our original strategy, but as the times change, we're realizing we have an opportunity to really focus on decarbonization, convert systems to electric, add solar. This happens to be a garden-style property with 22 buildings, so there's a big opportunity to generate our own power on the site. And of course, there are resources related to that too that help us finance those improvements, right? And so we're partnering with the state where this property is located, roughly to secure 80% of the cost in financing, and 20% we have to bring to the table in capital. But again, we believe it's sort of in the long-term best interest, not just from a maintenance standpoint to have all brand new HVAC equipment, but also from a decarbonization standpoint. And so there's a return on investment sort of approach to that we believe it's good for the environment, it's good for the residents, it's good for the business all at the same time. So that's kind of the evolution of this as I see it within an acquisition strategy.
Great, thanks. One of the other, within climate, the MIC framework asks for a climate risk assessment, and I guess really looking for an emergency plan and an understanding of resiliency. So Fabiola and/or Lauren, would love to hear your thoughts on resiliency and how that can create value for your investments.
Yeah, I can start with that one. So I'm in asset management. So, we try, both Lisa and I, we try to kind of educate our acquisition team to kind of think about this during the DD process. And so one of the first screens that we do have from a climate resiliency perspective is kind of just using the standard Moody's report. It kind of benchmarks where a potential asset is located and what the potential risks are for flood, any sort of extreme weather events. And we take that information at the asset level, one, to just understand what the potential risks are. And we're a new fund. We're getting smarter and trying to use the data that we extract at that time to make a more a decision on kind of what the path forward is. And we think about climate resiliency from 3 layers. One is, okay, we do understand what this risk is. What could the potential mitigant be? New York City scores the worst from a flood perspective. Whenever you look at any climate resiliency report, but it's one of the it's a high cost market, and affordable housing is needed here. So just thinking about different ways, or whatever information we gather at that time to facilitate an investment, where we sit on a ton of kind of education webinars, and I'd say our European partners are probably a little bit more advanced from a climate resiliency perspective, but we do think about it from one, what could the potential capital equity loss would be during our ownership. We also think about what ways that we can protect ourselves through insurance, or just ways that we could collectively within the partnership protect ourselves from a climate event. There are some things that we can't control. I think if folks are familiar with what occurred in Asheville, every single climate resiliency report did say that Asheville was one of the safest place to own. And then we had a severe weather event that no model, no report would have ever predicted. So it's just also trying to think in the back of our minds, kind of like what, from a financial perspective, the risks could be. And then, taking it a little bit more kind of analytical and portfolio-wide, what value could be at risk in specific markets for different events.
Yeah, I think just to speak to that business case a little too, as you're looking at the portfolio, ensuring that you're not overly concentrated in certain areas and things along those lines. One of the things that's been interesting, I've been in this sector for a long time, focused earliest in my career on sustainability. And so one of the things that's been interesting to see really, I'd say of late in the last year, is real traction around the business case for resilience. We've spent a long time demonstrating the business case for energy efficiency and water conservation. It pays back. Resilience was always this concept out there. Maybe there's going to be some future event that's going to be costly and damaging, but maybe not. And so I think what's happening now, right? We're seeing these big dramatic events. We have, dozens of billion-dollar events every year just in the US. And you're starting to see insurers, blanket remove themselves from entire states, right? Try to get flood insurance in Florida or wildfire insurance in California. You're not getting it. And so there are real economic impacts right now to physical climate risk. And so ensuring you're investing in the right areas, looking at key features like the structure and the construction of the building, and even policy items that are in place. What does your landscape maintenance look like in California? Do you have a bunch of dry brush that's going to lead that wildfire right to your doorstep? And so there's a lot that we can do as owners and asset managers to ensure that our properties are safe from these physical harms, and we're investing in the right areas. I will add, sorry, one additional thing too, right? When we think about climate risk, we talk a lot about physical risk, but transition risk is real and there as well. We're seeing it in the U.S. in terms of, building performance standards. Here in New York, we've got Local Law 97. I don't know if the property we're talking about is electrifying is in Maryland, but they're pushing, there. And so decarbonization isn't just for the climate, the good of the climate. Oh, I guess it is, but we're not being pushed to do it just because we care about the climate. We're being pushed to do it because there's regulation that's going to fine us if we don't, right? And so there's a business case for that. I think as we look into the future, it's going to be hard to access financing because lenders don't want to have their assets in areas that are going to be, subject to physical climate risks or to even access the equity side, because, Europe, I would say, is leading this, but they understand that they don't want their assets exposed to a lot of risk. And so we're going to see changes in the financial markets as well.
There's one thing I wanted to add too. Like, we're also starting to think about human resiliency as well. So like in Houston, if there's a power outage, if we have a ton of residents in our buildings that are elderly, where can they go? And so in some of our emergency preparedness plans, we're starting to talk about like resiliency hubs in these different markets in the event that something does happen. So.
Thank you. And I have more questions, but I see that we are at the time for questions from the audience. And so we can open it up to anyone who has a question for the panel, or I can keep going. We have a question.
I was just curious. I mean, I can see how the programs add value for the residents, for the communities, for the investors, but I was kind of troubled by one of the comments that Chris made about the dependency of the subsidies in order to keep this going. And I was wondering if the ROSI model has been tried for demonstrating to HUD and other agencies the cost effectiveness of these programs.
We have not, but I'd love to hear, Chris, any thoughts you have.
Yeah, I think the root of the question is, right, that this industry does have some dependency on federal resources, state and local as well. And what are the sort of societal returns associated with that? And I can't say I have that research at my fingertips, but there is a lot of research just about, the societal advantages of, housing the underhoused and sort of allowing people to live stably so they can thrive, they can access jobs and contribute to society and things like that, right? If you look at, obviously the issue of homelessness is the extreme, right? Where that's created real challenges for local government and state government and federal government. And I think there's sort of very good research that suggests that, it's good for the nation to sort of have a housed population that can afford their rent, can access homeownership opportunities and the like. And so there is a benefit to society that, that runs alongside this for sure.
Thank you. Any other questions? I see one in the back.
Thank you. Hi, I'm in a parallel type of industry, and I guess real estate development, but in like the sports and entertainment industry. And so no one's necessarily living on our properties, but this idea of using buildings and community spaces for resiliency. And I'm curious, not just how do you think about making those buildings resilient, which I think you covered, but how can we think about those spaces to help the communities kind of become more resilient? I guess flipping it on its head. Curious, any thoughts there?
Yeah, I can speak to that a little bit. So I first of all, I love that that's where your head is at, right? Like, how can I take my asset that, nobody's necessarily relying on in a certain event, and make sure that it's benefiting our community in a positive way. I think you have seen instances, right, like in the Superdome where people were living there, right, during Hurricane Katrina, or like in Houston, right, we've seen those sports arenas become a refuge, right, from these areas. And so I think, just thinking sort of more broadly to real estate development strategies, right, community engagement and listening, getting stakeholders together and listening to what the needs are, would be really a helpful thing that I would recommend. So first of all, as an understanding your own physical asset, do your own climate risk assessment, understand what your risks are going to be, harden that asset so that it can, you can keep the lights on or the heat on or whatever in whatever events that you're expecting. And, maybe the needs are going to be, hey, we're going to need a cooling center because, hey, here in Texas, we're going to have 100 days over 115 degrees or something, right? And so we're going to see these increasing events. I think that there is a role for these big community venues. But the best way to plan for it is to engage with the broader community. Lots of cities and towns are starting to have positions of, chief resilience officer or chief climate risk officer, et cetera. And so kind of working maybe with some of those people and those groups to assemble the right team and the right community stakeholders to develop your plan and figure out what is the role of a particular venue, would be really, incredibly helpful, because too often people are thinking about their own physical site, right? I think we all saw that. Well, maybe not, but many of us saw the picture after the wildfires recently of the one house standing and everything else was burnt down. And they're like, oh, it's a passive house. How amazing, right? But you can't go there, right? It's not, no one wants to live there. It's toxic because all your neighbors, the whole neighborhood burnt down, right? And so maybe that physical structure is a resilient asset, but that's not a resilient community. And so we really have to be thinking about resilience at the community level. And so I applaud your your leadership on this, because it's a great concept.
Great. I think there are no more questions. And so I'd like to thank our panelists for joining. And I'll just let everyone know. I was just going to add that we should be concluding the research on affordable housing and the application of ROSI by the end of the year. So stay tuned for that. Thanks again.